US stocks have had an amazing year so far, with them offering crazy returns mainly driven by tech and AI hype. Looking at the S&P 500, the index that tracks the performance of the largest 500 companies in the United States, we can see that it is up by 13.23% in the year to date. And the Nasdaq 100, the index that is dominated by the big tech and AI stocks, is up an incredible 35.27% in the same period. So really some incredible results from the US this year so far. Meanwhile, the UK stock market has been comparatively pretty boring and stagnant, with the FTSE 100, the index of the largest 100 companies listed on the London Stock Exchange, only up by 2.02% in the year to date. So it is clear that the AI-driven bull market has not extended to the UK, which, as you may be aware, is unsurprising given the lack of tech stocks listed on the London Stock Exchange. The sluggish nature of the UK stock market is emphasised further when you look at the 5-year performance of the FTSE 100, with it being up only 2.61%. In fact, up until recently, the FTSE 100 was actually down from where it was 5 years ago. On the other hand, over in the US, the S&P 500 and the Nasdaq 100 over 5 years are up 48.97% and a massive 93.49% respectively. So, with those figures in mind, you may be thinking UK stocks are a very bad investment and asking yourself, why would you bother investing in them at all? Well, in this video, I'll look at 3 key reasons as to why UK stocks may be attractive to investors. I'll draw on comparisons throughout, before sharing my thoughts, and finally showing you different ways you can invest in UK stocks if you decide they are for you. Remember, these videos are not financial advice or a recommendation to buy any stocks. They're for educational and entertainment purposes. When investing, your capital is at risk. The first thing that UK stocks have going for them is that they can be considered cheap at the moment. So, what do I mean when I say UK stocks are cheap? When stocks are referred to as cheap, the most common reason for this is because the PE ratio, or price to earnings, is relatively low. PE is simply the current share price divided by the earnings per share. Oversimplifying this massively, a high PE ratio could potentially mean that a stock is overvalued, whereas a low PE ratio could indicate a stock is undervalued and thus cheap. With that in mind, let's take a look at the PE ratio of the FTSE 100. The easiest way to see the most up-to-date PE ratio of the FTSE 100 that I have found is to look at the iShares FTSE 100 ETF webpage. We can see that the current PE ratio for the FTSE 100 is 12.05, so on average, FTSE 100 stocks are trading at a multiple of 12.05 times their earnings. In comparison, the S&P 500's PE ratio, which I am finding by looking at the iShares S&P 500 webpage, is 22.23, so a significantly higher multiple of earnings than FTSE 100 companies. To visualise this more clearly, I'll bring in some big company names, rather than just referring to the indices as a whole. The top 5 companies in the FTSE 100 are Shell, AstraZeneca, HSBC, Unilever and BP. And the top 5 companies in the S&P 500 are Apple, Microsoft, Amazon, Nvidia and Alphabet. I'll put all their individual PE ratios on screen, and you'll see there is a clear difference in PE ratios here, with the only high-ish PE ratio in the top 5 UK stocks coming from AstraZeneca, which is quite normal for pharmaceutical companies. I will explain shortly why you should not read too much into these individual PE ratios, but I just wanted to visualise the big difference in PE ratios between UK and US stocks with well-known company names rather than indices. Although comparing the FTSE 100 to the S&P 500 is interesting, it's not really a fair way of deciding that UK stocks are cheap, as there are an array of differences between UK and US companies, namely the sector difference. A more accurate way of drawing conclusions is by comparing the current PE ratio of the FTSE 100 to its average. According to Forex.com, from June this year, the average trailing PE ratio of the FTSE 100 was 14.9 over the last 5 years, and 16.3 over the past decade. So those averages are significantly below the current PE of 12.05. Therefore, by its own standards and recent history, FTSE 100 stock prices are, on average, a lower multiple of their current earnings and can be said to be trading more cheaply. Before we get too carried away and thinking we should load up on UK stocks at bargain prices, let's take a look at the current PE ratio from another perspective. Firstly, stocks trade at lower valuations for a reason, with a key reason being that people may be pessimistic about future potential, earnings, or wider economic outlooks. This negativity is priced in, which in turn results in a low PE ratio. In regards to earnings, a company may be trading with a low PE ratio because investors are expecting earnings to decline in the coming years. However, in my opinion, this is not the case for most UK FTSE 100 stocks. I don't think it's because investors think earnings will decline particularly, although they may, but more likely because they do not see much potential for growth in earnings when compared to growth opportunities offered by companies in other countries. This brings me on to my next point to consider when looking at PE ratios. which is that a high PE ratio does not automatically mean a stock is overvalued. They can be justified if earnings are expected to grow significantly. Look at Nvidia in the US, for example. Up until recently, Nvidia had a PE ratio of above 200, but it then came out with its latest earnings, beating its target massively, and now the PE ratio has pretty much halved to around 100. This is still incredibly high, and they will have to continue bringing exceptional earnings to lower that PE and justify the current share price, but it does show just how quickly PE ratios can drop if good earnings results come in. Nvidia is just one example of a company in the sector that dominates the S&P 500, which is tech. Tech stocks have offered amazing returns in the year to date, widely due to the AI hype. Investors are expecting the big tech companies to benefit from the rollout of AI and see their earnings increase significantly. Looking at the top 10 constituents of the S&P 500, 8 of these can be considered tech or AI stocks. The FTSE 100, on the other hand, does not have a single tech stock in its top 10, and in fact, looking at the sector breakdown of the iShares FTSE 100 ETF, we can see that tech does not even make up 1% of the index. This lack of tech in the FTSE 100 helps put into perspective why valuations may be low at the moment. Alongside being pessimistic about the wider UK economy, investors are not seeing FTSE 100 stocks as growth opportunities and are choosing to allocate their money elsewhere. To sum up, FTSE 100 stocks are at valuations below their recent historic average, which could suggest they are cheap at the moment, but on the other hand, they are cheap for a reason, namely the lack of growth stocks in the index. Moving on to the next reason that makes UK FTSE 100 stocks attractive. The FTSE 100 may not include many stocks that have had huge increases in the value of their share price, but it does include many great dividend-paying companies that have an exceptional track record of paying out dividends to investors, which in turn makes the FTSE 100 an attractive choice for those looking to draw an income from their investments. And it is also worth remembering that your total return from investing is the sum of the return of the value of your shares plus any dividends received. So dividends should definitely not be overlooked for those looking to grow the value of their portfolio either. So, what is the dividend yield of UK companies? Well, let's return to the iShares FTSE 100 ETF to find out. The 12-month trailing yield for the FTSE 100 as a whole is 3.75%, which is a very attractive yield for a diversified fund. To put that into perspective, the iShares S&P 500 ETF has a 12-month trailing yield of 1.34%, which is nearly 3 times lower than the FTSE 100. So, although the S&P 500 has offered much better returns overall in recent years, you can see why UK stocks are attractive for dividend investors and those looking to take an income from their investments. Dividend yields are one thing, but we can also see that the FTSE 100 has a pretty good track record of dividend payments, with dividends having a general trend of increasing year on year. Of course, you can see the big COVID dip in 2020, but it does look like dividends are back on the way to where they were before. Before moving on to the potential downside of high dividends, yes, there are some negatives of receiving dividends. I'll quickly go over some individual stocks to show examples of the sorts of high-yield UK stocks that are available. Some of the most attractive dividend yields in the FTSE 100 come from the financial sector. You have companies such as Legal & General, Aviva and Phoenix Group, which currently have dividend yields of 8.6%, 7.9% and 9.7%. Of course, there are many more stocks in the FTSE 100 with high yields, but these examples really illustrate why dividend investors may be attracted to the FTSE 100. So that's just a glance at the dividend yields of the FTSE 100, but let's now look at the negative side of high dividend yields. Although receiving dividend payments can provide a good psychological boost and contribute to your total investment return, you have to remember that if a company is paying out cash to you, they have less cash themselves to reinvest back into the business and grow. And returning to the sector breakdown, the FTSE 100 is dominated by large companies in sectors that have less potential to grow and would rather pay out dividends. Whereas when you look at the tech stocks that dominate the S&P 500, you'll see that they all have tiny dividend yields when compared to the FTSE 100, but they have offered much greater total returns by retaining cash, reinvesting and delivering significant growth in earnings over the years. The next point to consider about dividends is that they are not guaranteed and can fluctuate massively. If you are investing in the FTSE 100 over the S&P 500 purely for the dividends, it is important to remind yourself that companies are never under an obligation to pay a set dividend and can cut them whenever they like. Let's return to the annual dividend chart of the FTSE 100 to illustrate this. If you were relying on your investment in the FTSE 100 to provide you an income, you would have had to deal with a significant shock to the amount of income you receive in 2020. And although it is coming back up, your income would still not be back to where it was previously in 2019. If you are investing in individual stocks, one way to work out whether a dividend is at risk of being cut is by looking at the payout ratio. The payout ratio is simply the percentage of earnings that a company pays out as dividends. The closer this number is to 100%, the greater the risk to the current dividend amount. Take Legal & General for example, which has a dividend yield of 8.6%. A dividend yield this high can sometimes ring alarm bells for investors, but in Legal & General's case, the payout ratio is currently 58%. So the current dividend is arguably well covered at the moment and not particularly at risk to any cuts. This could change if earnings decline, so bear that in mind too. So to sum up point 2, the dividend yield of UK FTSE 100 stocks does make them attractive for dividend investors, but we have to remember that dividends are not guaranteed, and even when taking the higher dividend yields into account, the FTSE 100 has offered lower total returns than the S&P 500. Before I continue, I'd really appreciate a quick tap of that like button. It really helps the channel. Thank you. The third and final reason I'll go over as to why investing in FTSE 100 UK companies could be attractive is their defensive nature. The FTSE 100 is well known for being a comparatively defensive investment when compared to the S&P 500. As IG puts it, defensive stocks can be appealing because they usually outperform the market during recessions. Regardless of external events, their dividends, earnings and share prices usually remain comparatively stable because they offer a product or service for which there is consistent demand. Returning to the FTSE 100 top 10 holdings, you can see that companies in the energy, consumer staples and healthcare sectors dominate the index. These are all sectors that do comparatively well in hard economic times, as people are less likely or unable to cut down on their spending on this type of product and service. The defensive nature of the FTSE 100 was put into display last year in 2022, when an S&P 500 ETF dominated by tech stocks suffered a nearly 20% decline, whereas a FTSE 100 ETF would have actually given you a positive total return of 4.6%. Therefore, if you're worried about a recession or bad economic times coming, then the FTSE 100 may be a more attractive investment than the S&P 500. As well as being dominated by stocks in the defensive sector, it is also worth noting that the performance of the FTSE 100 is not really correlated to the performance of the UK economy, as FTSE 100 companies make most of their money from abroad. And this is not just slightly either, with FTSE Russell data indicating that circa 82% of FTSE 100 companies' income is derived from overseas. When you combine this fact with the defensive sector dominance, a pessimistic view of the UK economy should not really be a deterring factor when it comes to investing in the FTSE 100. So, as with the other two reasons, I'll go over the opposing view as well. It will be a quick one this time. First of all, it is worth pointing out that this defensive nature is mainly applicable to the FTSE 100 specifically and not UK stocks as a whole. UK stocks in the FTSE 250 make a greater proportion of their income from the UK, with a comparatively lower figure of 57% of income coming from overseas. The FTSE 250 is also not as dominated by defensive sectors, with nearly 42% of the index in the financial sector, which can be much more dependent on the state of the economy. So please keep in mind that this reason is focused on the FTSE 100 and should not be extrapolated to the whole UK stock market. Also, it is important to remember that the defensive nature of the FTSE 100 can also be considered its biggest weakness. As I've alluded to many times in this video, the UK just does not have companies with great growth prospects when comparing to the tech-driven S&P 500. Defensive stocks may perform better in some years, but as the data shows, overall the S&P 500, with its more aggressive growth stocks, has provided better returns than the defensive FTSE 100. So, to summarise the final reason, FTSE 100 stocks tend to be more stable in hard economic times, but this is with the trade-off that it has not provided as impressive returns as the S&P 500 overall. I hope this video has helped you see the pros and cons of UK stocks. Remember, always do your own research before deciding on any investment. No one knows for sure how the stock market will perform, and you have to decide yourself where you think the best place to invest is. My thoughts are that FTSE 100 companies can form an important part of a diversified portfolio, and the dividend yields do make them nice psychological stocks to hold, with dividend payments providing motivation. That is it for this video. Be sure to let me know what you think in the comments below. What do you think of UK stocks? If you're interested in what I invest in, then be sure to check out my monthly portfolio updates.